What does Nvidia and stock market crash have in common? Well, as it turns out, the last 5 times we saw a split, something very strange occurred. It ended up in a bear market for the S&P 500. So what's going on with the dot-com crash and the AI bubble that's forming right now? In today's video, we take a look as investors and traders together at where we need to be watching the flows, the dark pool liquidity transactions throughout the equal market, and how US oil and Brent might be turning the ship towards the upside. Some really interesting stats to go through today, guys. Let's talk stocks, commodities, and cryptos together. Well, welcome back, everybody, to The Daily Show. My name's Tom, and as always, we're discussing the macro, the data, and of course, everything about the big economic events, including inflation coming this week. If it's your first time here and you haven't subscribed, remember to do so. Smash that bell icon if you want to educate yourself more about where Wall Street's money flows are really going. So let's do a bit of a history lesson to learn up here about Nvidia and stock splits to start off with today. Then we'll go through the shorter timeframes of what we usually expect over the next few weeks and whether Nvidia is actually going to continue in an overall bull trend. So first up, the similarities between AI right now and of course the hardware boom of the dot-com bubble. Yes, Nvidia was around during that time, of course, as a gaming hardware device, and it ended up having 2 splits into the dot-com crash. Funnily enough, during this particular period of time, we saw, of course, some interesting action. We ended up getting 1 split and then a second split very close together. Also seeing a similar type of phenomenon back in the global financial crisis or just before that period. Now, why do we get a stock split? Well, it's generally because the stock's doing really well, it's growing, and it's becoming a high price. And when that happens, options become expensive. They like to lower it to allow more people to, of course, participate, particularly us, the retail traders. And that's exactly what's happened today. So what we've seen in the past is that during these bubbles, during these huge swellings of economies, we generally see a few stocks leading. And it's the leaders that become the most important. If you know anything about your 1990s history, then you would know that Cisco and Intel were 2 of the largest bubbles during that time, both hardware, both to do with the internet. And in this case, you can see an overlay here from 2016 Nvidia to 1992 Cisco. And they're actually both crescendoing into a very similar period of high here. But just remember, each new bubble usually is higher than the last. And in this case, the higher PE, I think, of Cisco during that time was quite worrying. It was like 70-something, 80-something forward PE. Right now, of course, Nvidia is not trading at that much amount. So if we kind of say, all right, well, maybe we're not quite in the bubble territory, what are we looking for? Well, we're looking for people to have outrageous targets. In fact, just today, I saw a news article that said that Nvidia could become 15% of the S&P 500 total market. Now, that's the type of news article you want to start seeing. And I think this will become more and more prevalent over the next 12 months. And this is where I want to get into the average 12-month return after the announcement of a stock split. Guess what? It's pretty good. In fact, it usually 2 times as the S&P 500 over the next 12 months. So while Nvidia has problems, let's say on the second stock split, if they're very close together, the first one could be actually quite nice. And if we consider this, we need to be paying attention to what happens next. So what do we generally see after stock splits in big tech companies over the last couple of years? Well, since 2020, it's been pretty favorable. And actually what we've generally seen is a weakness initially into a strength over that next 12 months. Tesla, Amazon, Google, Microsoft, Apple, just to name a few, all experience somewhere between 10 to maybe even upwards of 20% after a stock split sell-off. But what ended up happening was the first 1 to 3 days were sometimes positive, and after that period, we did sometimes see a gradual decline over the next kind of 1, 2, 3 week areas. So will it happen again for Nvidia? Well, it's been circling the internet, and of course it is quite a well-known phenomenon. But why I think Nvidia is the most important stock, and again, semiconductors is the most important sector in the markets right now, is that all bear markets end up being forced in by, of course, a change in leadership. Effectively, what happens is we see a particular market bubble off, and that market then explodes and leads into, of course, the crisis or crash. Now, I think most of us would agree semiconductors are the big thing right now. They are AI, they are the revolution of the markets. And of course, the markets are becoming more and more concentrated in terms of leadership. And that will be important when we look at the Q versus SPY combo a little bit later on in today's charts. Can it help us making better analysis in these markets? Well, I want to quickly go back over to the .com bubble. What you'll notice here is that we see a huge rise up, a massive fall off, similar to what we actually saw recently with Nvidia, and then we get a massive new secondary bump. And this tends to be kind of the way that you usually see a lot of these hyper bubbles. A huge rally followed by a dump that's pretty significant that shakes people out, and then the rally continues. Now, that's fairly symptomatic of pretty much any major bull market. And I think it's something that you'll be wanting to look out for. And of course, we'll be doing so together on this channel. So that's going to be an interesting one as we follow along with semiconductors and Nvidia. Another reason that's supporting the market bull case for now anyway is that we are in the buyback era. And the buyback era seems to be accelerating with more and more stocks during earnings basically just saying, don't worry guys, we've got a buyback program. And that's going to lead us into making sure our stocks are kind of, let's say, made a put underneath them. Basically, a percentage of stock buybacks are causing these markets to go up. And we talked about that in our previous video. Check out that after the end of this one. So let's go through no landing. Back in debate, and that's not really bearish. This is a Bank of America research report, and it can show you here that no landing is back in debate. It's not bearish. And it looks like everybody has started to ignore the biggest problem in the room, which of course is going to be the bonds market and the fact that we are still inverted. Now, inversion of yield is going to be a very important factor, but let's have a look here at consumer sentiment, Twitter sentiment, whether we're stretched right now in the shorter term, because of course, if we are, then that's maybe where Nvidia might weaken, and then whether we actually are still seeing growth overall. So consumer sentiment first up, as seen here from Goldman Sachs Twitter Economic Index, you'll notice that it's getting more and more bullish. Now, I think a huge part of this, of course, is GameStop, but also Nvidia craze. Coming into the split, everyone's loving it, and everyone's loving GME as well, and that's leading into a very high Twitter sentiment. In fact, it's getting up there with the likes of 2021. We all know how that ended up. It didn't end up very well. So what about Goldman Sachs' own sentiment indicator? Is that stretched? Well, we saw something similar to this back in 2024 in March, and it led into a bit of a decline in markets, around 5 to 6%. Now we're getting stretched once again. It's starting to get kind of a little bit more up to the top end. So if we get to 5,400 or a level that we'll look at later on in today's video, then this could become very stretched, and again could lead into something like Nvidia leading a little bit of a sell-off for now, that kind of double-digit possible loss. Remember, that will hit the markets across the board if it does occur, because semiconductors are the leaders in this current market condition. So let's talk about CPI. Will CPI affect this market? Well, everyone's going to be talking about it, and of course, it is a massive news event. It can be a catalyst, but if we take a look at most of the previous ones here posted by Heisenberg over on X, you'll notice that we have in general a pretty bullish stance. Basically, every single dip that was occurring from recent CPIs has been purchased up straight away. And that will come very important when we're looking at key levels, of course, on the charts. Goldman Sachs also expects basically for CPI, for inflation to start to moderate. They're seeing their core inflation tracker actually dropping back down to 2, which of course is a positive factor for markets. And you can see here that Mike Zaccardi has shared some stuff from Goldman Sachs showing that they believe that overall the trend is looking better for inflation. In particular, I think the interesting thing here is that they believe rents will actually decrease over the next 12 months. And that's the sticking point because, of course, rents have been the biggest factor of sticky inflation. That is one of the things that's the hardest to get out of the inflationary market. And at the moment, it's been incredibly consistent in terms of how sticky it is. So what other factors do we have from the bull and bear case scenarios? Well, of course, we've just seen Nvidia split. We know that that can create at least a little bit of initial weakness. And we're making new higher highs, but we're not seeing the overall stock market come up. As we mentioned before, RSP, the equal weighted market, has not really been advancing to new all-time highs. So that means the advanced decline line, such as in this chart right now, has actually been weakening as the stock market's gone up. Now, as we've proven in previous videos, that's not necessarily a super weakness period. And do remember that June, since 1948, and this is going back past 1950 now, has only ever seen one topping ever. And that was in 1948. So it takes a while to go back to see that the market has ever topped off in June. It's incredibly rare to do so. And I think, yes, you can rewrite history, but it's unlikely to do it. Remember that concept of concentration. You would think that having a concentrated market is bad, but as we've proven in the past, here we can see that a concentrated market, one led by a new rally in some kind of technology, in this case AI, is not necessarily going to dump the market overall. And in fact, it can lead into pretty much hyper bubbles. So why is this important? Well, we have to continue to watch those strongest markets. Also, for everyone looking and wanting some kind of cut from the market in terms of interest rates, just remember this chart here, that when the Fed cuts, they do not do so out of the goodness of their heart, and they instead do so because they broke something. So just remember this when we see a cut. Sometime in the future, generally after cuts, something bad happens. So you kind of want the Fed to keep interest rates either stable, or even if they rise them, that basically means that something's pretty strong behind the closed doors. Now, you may disagree with this chart, but that's at least what historically has happened. And do remember, if everyone disregards this chart, it's more likely to actually occur when it next happens. So where are we right now in this secular bull market? Does it make sense for something like Nvidia to continue to climb? Does it make sense for that to be the first stock split and possibly there's a second one on the horizon? Well, the short answer is yes, especially if it continues to get carried away and get wild. Because of course we are around here, and a normal, wild, secular bull market can last quite a lot longer. And a factor of 1 to 2 years plus more actually is still possible in a market such as this. And you can see that's leading into that 2026, 2027 narrative, although I think there'll be problems a little bit faster than that, and we'll be on the lookout for them. What about year presidential cycles? Does that make sense as well? Well, as it turns out, it does. Of course, markets generally do rally into the end of the year. Of course, they're usually blips because this is going to be a hotly contested overall election. And then we'll end up moving into usually some strength as we see new whatever reforms come out, usually hopefully positive towards the market. And then we could start to have some troubles during the 2026 period. So before we look at the S&P 500, let's take a look at a few other market flows. First up here, Bitcoin ETFs. We talked about this last week and we saw a lot of inflows just near those highs, although Bitcoin was not able to break through that 72.5, 73K zone. If it does in the future, especially how it's coiling right now, it could get absolutely wild. So stay tuned for that. Does it make sense for it to get wild? Well, kind of, yes. Over the next month, this is usually the period of a halving cycle where you start to see acceleration. Now, I'd probably ignore 2012 a little bit. That was a wild time. But 16 and 20 could be looked at. And in both cases, we start to see some acceleration of Bitcoin over the next coming weeks. So this is going to be a very interesting time to see whether we still could be on something like this halving cycle. A lot of people expect it to happen earlier. Generally speaking, we're actually on track for it to happen relatively soon. Now, this is an interesting chart here from Macro Charts, and it shows that hedge fund positioning as a percentage of open interest is the lowest it's been in an incredibly long time when it comes to oil. And basically, we know that they might need to actually pick it back up. And this can actually lead into some pretty decent exposure pickup that ends up coming back into the markets. As we've talked about before, we know that what we reached last week was a very important defensive zone for oil. And there are powerful forces here between OPEC doing what they're trying to do, and of course political struggles around the world trying to keep oil cheap, that are forcing this into being one of the hardest trades around. But at the same time, when you hit a key level like we did, you'd be looking for signs of strength. And of course, we have started to see those come through very strongly, and we'll talk about them very soon. From the dark pool liquidity, as I said, there was something that we did end up catching over the last 24 hours. You can see here, volume leaders is showing a 12 read on dark pool activity. And while this could be a sell leading into inflation, it will be a very important factor. Of course, we saw some massive ones here just before the sell-off back in April. Will we get a sell-off here, or is this actually an accumulation? That we're not too sure on just yet. But I think after CPI, we'll probably see their hand, and that could lead into significant rallies. or of course could lead all the way back down into these lows again. And I think either way, there'll be a trade here coming up. Let's talk about flows. Now, we know that leaders is good. So semiconductors leading is kind of what you want to see in these markets. Although we've seen a lot of inflation trades have pretty significant pullbacks. We've seen regional banks coming down over the last 5 days. Gold's, of course, not formed very well. And one of my favorite sectors has had the pullback that we knew we had to have, which of course was metal. So 5 days, when you look at it in that aspect, doesn't look very good. Over the last 24 hours, a new emergence, of course, solar has been doing well. Nice. We're liking solar right now, mostly driven by government, and utilities had a little bit of a pickup as well. And I'll tell you one thing about utilities. It has some of the largest flows in it right now that it's had in a very long time. And that usually means it's a little bit overbought. Of course, it's a lagging indicator. So it shows us that the flows came in about a week or two ago. And you'll notice that was the high currently of utilities. So I wouldn't be surprised to see utilities fall a little bit and then rally back through. Still a market or still a sector I think will do very nicely in this late cycle stage that we're in right now in these markets. So let's jump on over to the S&P 500. What's it doing? Well, it's kind of going sideways. The most important thing usually is that you see leading, and that's not what's happening. You can see here this advanced decline line actually continues to go down as the market goes to new all-time high closes. So is that negative? It's not the greatest, but doesn't necessarily lead to really weak markets. As you can see here, the S&P, it's been up, down, all around in terms of overall positive or negative delta. So let's now take a look at the US 500 futures. And as you'll see, they're fairly trapped into this week's big numbers. The CPI, the PPI, the Fed, and everything else is about to come out. And what does that mean? Well, coiling is occurring. So it will be important to look at this and the Russell and the Dow for bits of signs of maybe weakness in other markets that could give us a bit of a clue. But in this case, it's quite happy with where it's at. And it is in an upward trend. A series of still higher highs and higher lows means that the market is still firmly entrenched bullish. Where does that change? Well, to me, it's going to probably be around 50 to 80. If the market manages to get underneath that level, it's probably going to be starting to look towards the bearish side. And from a factor of breaking through certain things like daily 20 moving average there, anchored VWAPs and other stuff, that will also become an important factor. So what are most people banking on? Well, I think most people are looking at positive gamma and they're focused in on the idea that 5,400 could be reached after the inflation numbers and maybe even higher. And that probably still becomes the most interesting and probably normalized level. Notice here, over the last 24 hours, this has been where we've seen resistances anywhere upwards of about 53.75 to 53.80 is where the resistances are. And the put support is firmly entrenched around 53.40 for the Tuesday time. So we're kind of just trapped between those two options levels. Speaking of options, let's take a look at those. And you'll notice we still are in positive gamma phase in terms of the markets being able to rally through these levels. But there are a lot of calls. So with inflation coming this week, if we manage to hold higher, as you can see here, as we lead into the end of the weeks and OPEX next week, it'll be basically a point where the higher the market goes, the more bullish pressure will end up being in there. If the market's able to break through some of these key levels, in my opinion, probably 52.80 to 5300, that kind of zone, then I would say we're going into negative gamma territory. But I would say that still the market favors probably the bull in this case. What do you think, though, in the comments down below? Let's move over to whether the CTAs agree with that statement. Well, from the NASDAQ perspective, they do. You can see here NASDAQ CTAs have been increasing. You can also see S&P overall increasing. And effectively, they are neutral to, I would say, bullish. From the Brent side of things, you'll notice that we have a little bit of a decline in Brent, but it's stabilized now from CTAs. And if you actually looked at the next 24 hours, which we will over the next couple of videos, then I would say that overall CTAs will be purchasing back into Brent based on the flows that we've seen. Gold, on the other hand, went from being more bullish to super bearish. And we'll go through that chart soon because that was a very interesting non-farm payrolls. Actually, before the non-farm payrolls, we saw significant weakness. What about some other noticeable options here or notable options in the markets? Tesla to start off with, still coiled. A lot of coiling markets between 180, 182.50, and you can see here actually 185 for Tesla, and 170, 172.50. We just have tons and tons of puts and calls. And they're all sitting, making this market do this as it's been an iron condor dream but of course, it could be a very big breakout dream soon. With NVIDIA, we don't get too much in terms of options because, of course, the stock split has stuffed up the chart here a little bit. But what I'm looking for with NVIDIA is, let's say we do rally after inflation. Let's say it doesn't even make sense and the markets go to 5,400. Remember, we do have that looming stock split curse that's been happening on a lot of markets. 1 to 3 days possibly up, and then weakness that's led into double-digit losses. Now, if that does happen, of course, especially if semiconductors are the ones showing the double-digit losses, you can imagine the market would be pulling back, in the vicinity of another 5 or 6%. And that would probably lead into some pretty significant shocks, especially through the put markets. What about GameStop? This has been something that a lot of people have discussed as well. Well, it's not that interesting. We kind of hit into one of our fib levels we spoke about last week, the 61.8, the 75 fib. And I was pretty sure that level was going to be a big sell-off zone. It just makes sense. People, they're trying to ape it, but at the same time, there's a lot of greed in this market. Just remember, you've got to safeguard yourself from any of these particular positions. And where we found ourselves right now is back onto the puts. So basically, we've got a put wall sitting here. If the markets do go down further, it's going to turn more negative gamma. And of course, it can put a lot more pressure on the downside. But I think people like Roaring Kitty, I believe, are now actually underneath on their options. So at one point, he was close to a billionaire. Now, unfortunately, those options are getting absolutely hit. Now let's move over to whether the market says there's weakness here. Well, the first up, the bonds indicator, bond options are actually declining. That's a good sign for markets. US 2-year yield stuck within the middle of zones. I'm not really too concerned unless this breaks either 4.7 or 5. So nothing interesting there on yields yet. And we have treasuries actually showing that maybe yields have stabilized because, of course, that's like an island reversal towards the negative side. So treasuries probably going to do a bit more sideways action, up, down, all around, and stabilize around these levels until inflation numbers come out. What about home builders? Well, again, they've stabilized. Dow Jones Transportation Average also found some buying pressure. And overall, central bank liquidity, being the Fed here and the world central banks, are both, I would say, relatively accommodative of this market being high in terms of they're not exactly, falling through the floor. Let's move over to the US dollar now. And the US dollar has found a couple of interesting things. Now, first up, this is a classic non-farm payrolls trap. If you notice, the stock market came down to 53.25, exactly the level we thought about, and it found instant buyers. And this is something we covered in our Market Masters Club during a special NFP stream. And I said, yeah, I bet you that's the level that we'll see the low because we had a massive gap on open and buyers instantly committed to that massive put wall that was sitting there. Well, the same kind of thing happened on the US dollar. If you remember back, this was a level I was looking at seeing a resumption of sell trend. But as always, you have to have the patience to react. And when the market did this kind of sell-off instant rally and it broke through that zone, selling here would have been very unlikely. And what we've ended up doing is coming back to the supply, which is the most traded zone. Could sellers still take control of the US dollar? Absolutely. Unfortunately, we're going to have to see more information because at this point, all we know is we're at resistance. If we break out above, the US dollar could seriously start ripping. And I would say inflation numbers and PPI will be the ones that lead that through. What about copper? Well, it failed to break through. And as it turns out, that was good because it wasn't a great buy there. Yeah. Now, a lot of people are getting super weak on copper. So there's a lot of negative stories about how China's been stockpiling. By the way, not a new story. Everyone's known that for ages. And all these other things. Now, of course, it climbed that wall of worry before, and now we've got a new wall of worry for copper. So what are we going to be looking for? Well, above the daily 20 moving average, this red line will become important. Above 4.7 will become important. And you can see at the moment, it's making a series of lower lows and lower highs. So if that switches, things are looking much better for copper, but they're not doing so just yet. So anywhere around this 4.5, this is where I'm looking for those reactions. And again, we'll just kind of remain patient on that one. What about gold? Now, this was a really interesting one. You might remember I talked about this being relatively bullish ahead of non-farm payrolls, and then it came back down. Now, I was actually looking for a buy in here. And what happened before the non-farm payrolls, I got the alert. And effectively what happened was it was coming down like a freight ship, like a freight train in my case. Now, if something comes down like a freight train, I want to see a bid. And as you'll see in a moment, there were no bids on that particular position. Key levels in the future to watch with something like 23.20, a breakout above here could signify that we've found buying bids on that secondary support we talked about on gold. And it still is possible that we're going to 2175, 2200. And it's still possible that I would be actually quite bullish at those points as well. Remember, the big story here is not quite the non-farm payrolls, but it's that China stopped purchasing the first time in 18 months in terms of purchasing gold. I believe they'll resume because it's part of an overall currency war that we're in right now, and it is imperative that they get a lot more gold. So I would say they will continue to buy it, but this is one of the storylines. Now, as I mentioned on bids, take a look at this 15-minute chart. Comes down, finds nothing. There's nothing there. There's no structure. There's no bid. There's basically nobody liking the level. Do I think that was a bad level? No. Do I think it was the correct level? Yeah, I think it was. It's just that we didn't get a bid. And then that's that next level for scalping, day trade, and those types of things. Then we've kind of come down, and throughout the non-farm payrolls, we made a series of lower highs and lower lows, which at the moment is still being tested. We're seeing whether we can get through that 23.15, 23.20. So the market's still weak here for gold for now. And when we look at the higher timeframes, you'll notice that this is a very important level. Is this the beginning of a double top? If it is, where do I think it's going? Next structure down here. And is this a potential buy? Well, of course, I've already had that marked for quite some time. And this is the level where I think a longer term positional buyer might be getting a little bit excited for gold. But you have to also look at silver. And silver, of course, looks like trash on the chart at the moment in comparison. Really bad weekly. Things started to look better. Closed the weekly poorly. Now it looks like it's kind of wanting to come back down to this 61.8 pullback. And again, if gold stabilizes around this point and silver gets back down to here, I could see buyers recommitting on both of them. So it's a very interesting time for the metals. And a lot of people are going to say now, oh, I don't care about these metals, these suck. Well, that's what happened last time. Remember, before this whole rally happened, we were really liking gold back in the 1900s and stuff and 1800s, and everyone hated it. That's unfortunately how trading and investing goes. It's about putting your opinion to the side a little bit and following the price action. And right now you can see the price action is quite negative on a chart such as silver, but that could change. And we're focused in on that 28 kind of an ounce there. Now let's move over to oil. Now this actually hit our really good bull zone for Brent and for US oil last week. And we didn't see what I would call day trading easy signs there. There were engulfs on daily trade, etc. But basically it was more just if you want to invest or buy as a position, you kind of just had to say, okay, I'm going to buy the dip there. And there were some cases for why you might do that. Of course, weekly markets in particular. I'll get rid of this for a second just so you can see the US oil chart a bit better. And you'll notice that we came back down to what has been significant buying demand. Now, OPEC probably defending that a little bit, and there's a lot more defense in general. Breaking of 80 a barrel will be incredibly important to get big swing traders in the future and position-based traders. But now, where do we find ourselves? Right at that point where you probably expect a bit of weakness. And let's say you're thinking, oh, I'd love to get some oil. What are some of the things you could do? Well, of course, you could have an anchored VWAP sitting behind. You could put a fib on and be looking for a 50 to a 61.8 fib retracement, something in here particularly. And it looks like we might find a little bit of weakness here. You've got to remember the trend was down. So if sellers are going to come back in, this is exactly where you'd expect them to start selling. So I think short term here, maybe US oil and oil in general drops a bit, but there were some very encouraging signs of how strong the bid was. Plus, when we look at that macro before of all the hedge funds being super underpositioned, they'll probably have to come back into this particular pair. What about Tesla? Up, down, up, down, up, down. Absolutely stuck within a range. Again, our opinions on whether this stock's good or not doesn't really matter. We can just see that we're trapped. We're looking for a breakout either side. Still got that set on alerts. So Nvidia, yep, it's got the big split in it. It's now worth 121.79. We all know what we're looking for in terms of whether there'll be some weakness. I think the big thing here is going to be CPI because as you can see, we're kind of trapped. So similar to what we mentioned over here, you are looking for signs of gap downs. Now, did we get one over here? No. But if we did get a gap down here, it would be an island reversal, and that could be a signal that maybe that dreaded post-split sell-off is coming. And of course, I think this will be the most important chart in many ways to be watching over the next week. Now let's have a look at GameStop. It's come back down to, as we know, a put wall, but also filling some of the gaps that it left over. And this would be somewhere in here. It'd be where you'd want to see GameStop start to find bid. It hit what we thought was a good target, and then it sold off from that point of view. HSI, Chinese market, looks really bad on a chart. I absolutely hated that third sell-off last week, that one there. That was really nasty, and that's leading into, of course, further selling off. It's possible that we now go down to the 17,690, and I still maintain that I think this is a strong market and that AI stocks in particular will do well here. But this is kind of that pullback you had to have because it became, again, an overtraded thing. Now, we've been looking at it very closely, and we almost got bid that was going to turn it around. It just hasn't happened quite yet. So some things that we're looking for, big fib retracements such as the 61.8 fib and levels around the 17.6. So it looks like it's going to make what has been making new lows here, and it looks like it might continue that for a while. Certainly a market that I'm watching very, very closely for new pickups. UK market now, time for that. Actually didn't find too bad a end up buy. We'd look for it through 8.250 in terms of finding more momentum through 8.3. Probably should resume upward trend. And this will come down to, again, the inflation numbers. Now let's move over to IWM. So this one was really weak, and we found a lot of net delta all over the place. We obviously saw that strength in net delta last week, finding that bidder, and then it just went and took the low straight away, falling down to 200 over the last 24 hours and finding a buyer. Now, I preferred the idea that the US 2K was going to hit something into 1988, 2000, but we'll see whether it can get down to that level. We'll be watching quite closely. And this market is, of course, suffering from higher for longer yield. So as the yield curve becomes more clear that maybe there's no cut in 2025, 37% of the businesses make no money. So that is an issue. US 30 Dow time now. A lot of people poking fun at this market and saying, yeah, well, it's at that supply. So this is showing that the markets are weak. And I would say, yes, it is actually bearish here on short time frames. So, of course, the Dow is maybe showing us that. So you could pay attention to it if you wish to. But, yeah, very important supply overall with some bearish signs in it. Still looking weak around this supply. This will be an interesting level for the inflation numbers. But it also comes back to being able to read the strongest markets. RSP right now, equal weight, absolutely sitting in between. If we want the IWM to improve, this, of course, will need to break to the upside and not the downside. A way of actually seeing whether IWM or Russell 2000 will actually be strengthening is also to take a look at this ratio, the Q versus the SPY. If the Q is leading, IWM hasn't really performed that well. It's more of that concentrated risk on in this current market of AI driving. And if it's going sideways, then that can be a period of time for significant strength in Russell 2000. So something to look out for in the future. NASDAQ remains quite sideways in terms of equilibrium, and then we move over to Bitcoin. Now, Bitcoin, two massive inflows over here, fails to get through 72.5, which was our trigger, and then, of course, it's sold back off. Now, I think inflation numbers and everything that's coming out over the next couple of days could be wild for this market, pushing down into maybe the 64.5 to 66 level, and if we see a strong buying reaction off that, I think it could be an incredible catalyst for crypto. So it's still coiling, it's still getting ready. As long as it stays within this range, it's still bullish, and it's something that is worthwhile paying attention to. Along with that, it's going to be the big numbers this week: inflation, projection, statement, and then conference. What happens here can often be reversed straight afterwards. So do remember that the conference is one of the biggest things, and that's that real half an hour kind of discussion afterwards. As always, guys, if you enjoyed today's video, make sure to subscribe and smash the like button, and also sign up for our newsletter. We're putting out a special one this week for the CPI as it's resuming again. And of course, we've also got a sale as well if you want to find out more about how we figure out where market positions are, and more importantly, get those scalpel-like entries. Thanks so much. Catch you next one. Bye for now.